The Small Business Administration just changed the rules for the loan program that people use to buy businesses. And this can have a big effect on you as you go to sell your business. And that's because more likely than not, the buyer of your business is going to use that SBA loan program to buy your business. So that means that your sale is going to need to fit within that organization's guidelines. And if your sale does not meet the SBA guidelines for the acquisition loan, you're probably going to sell at a lower value. So if you want to sell at the highest price, you got to live by their rules. So one of the old rules, one of the biggest things, and we really hate to see this go away, is that you could sell your business to a key employee, and the SBA, through their loan program, they would lend up to 100% of the money needed to buy the business. So that's not only just the purchase price, gives them the working capital, and it covers the legal and other deal costs. That is gone. And now for other buyers, the down payment requirements, most banks, the lowest we saw was 2.5% down was a required down payment. That's gone from 2.5% to 5%. So now that might not seem like a lot, but there were probably 5x the number of people that could buy your business at 2.5% down than 5% down. You know, from a risk perspective, who you're selling it to, it's kind of the same. They're both somewhat risky loans. You know, there isn't much of a difference between 2.5 and 5. But your buyer pool just probably went down by 80% with that change. And of course, what that means with fewer bidders, that means lower prices. And the way that the down payments work for the buyers of the businesses is that technically through the SBA loan program, buyers have to make there's a 10% down payment. But the trick is that 10% doesn't need to come 100% from the buyer. Some of that can come in the form of seller financing from you, which every transaction has some level of seller financing. You know, typically the range is going to be between 5 and 30%, kind of depending on different risk factors. But in every transaction, there is some level of seller financing. And if you structured it right, count towards their down payment. Under the most recent rules, to structure that right, the note had to be on what was called standby for 24 months. And standby means no principal payments or interest payments for 24 months. Now the rules say that that note has to be on standby for the life of the loan, which could be up to 10 years. Typically it's less, but when a buyer comes in, you know, they're going to have to set the expectation that it's going to be 10 years until that loan is paid off. I'd say statistically, some of the numbers we've seen is that, you know, the average SBA loan gets paid off in 3.5 years, but it is a 10-year term loan. So you should go in expecting that the life of the loan is 10 years. Another big area where we saw changes is partial sales. So it was relatively recently that the SBA reworked the rules that could allow a partial sale. So meaning that you sold 95, 90, 80% of the business to someone and you retained some ownership. And there are lots of reasons you might do that. Say maybe you needed a transition period where the buyer needed to acquire a license and they could operate under yours. Or just say you just wanted to hang on. You know, if they have a good growth strategy, maybe you wanted to keep some equity in the business so that if it grows, you get to realize some of that appreciation. And that's been made, you know, virtually impossible. Under the current rules, anyone that has ownership in a partial sale transaction has to guarantee the loan. So let's say you sold 99% of your company and kept 1%. You would have to guarantee the loan that was used to buy the business. And you'd have to guarantee the full value even though you only own 1%, which you don't want to do that. We would definitely advise against doing that. You know, there are some extreme circumstances where it might make sense, but in general, that's not something you're going to want to do. You don't want to guarantee the loan that is used to buy your business. You know, I'll give an example. We're actually working on something right now where the seller is going to provide that guarantee to the buyer. And the real reason is it's a manager buyout. That general manager helped him build the company. And basically he said, I will do whatever it takes to sell the business to this person. I want this person to have the business. So it's somewhat of an unusual circumstance, but he is happy to do it because he wants that person to take over. And he feels pretty good because that person has been running the business the whole time anyway. He's been in the business more than the owner has. So he feels pretty confident in his ability to keep doing it. But that's an extreme example. So there are circumstances where it might make sense for you to be on the guarantee, but 99.9% of the time you don't want to be on there. So if you need help navigating, getting your business ready for sale, or you're already ready to put your business on the market, check out that link in the bio and we'd love to help.